seems to be a revolt brewing among members of the Federal Open Market Committee. In fact, two regional bank presidents said last week that they want the FOMC to consider raising rates by later this year. But Friday's disappointing jobs report may have knocked that completely off the table. Let's get some perspective now from Mark Zandi. He's chief economist for Moody's Economy.com. He's here with us in studio. So on or off the table, or so far off the table that we shouldn't even be talking about it?
Not this year. I don't see a reason for raising rates, certainly not until early next. I think the key statistic for the Federal Reserve will be the unemployment rate. Not until the unemployment rate is definitively moving south will they raise rates.
The rate or the overall joblessness right now? Because the rate came down, but there's still questions about the health of consumers and whether there are jobs out there.
Right. I think it's the rate, but it has to be definitive and clearly moving south. So 9.7 isn't definitive or clear. If we're headed to 9.5, 9.0, then I think they think the coast is clear and they can raise rates. But given the way the job market's going, I don't think that happens until early next year.
How does the stronger dollar, relatively stronger dollar, factor in?
Just one more reason not to tighten monetary policy. It's unemployment, it's inflation. With a stronger dollar, that means that inflationary pressures will be even less significant, and therefore very little reason to raise rates anytime soon.
Now, investor reaction to the jobs report was fairly negative and very quick to the downside. Does the way the market's reacting make it look like the economy's in worse shape than it actually is?
Well, I think it was a bit of an overreaction, yeah. I mean, of course, there's a lot of things to worry about. The European debt crisis probably is at the top of the list. I think the way to look at the jobs numbers is take April and May together, take the average, and that's the reality. So April was strong, May was weak. Underlying job growth is probably somewhere around 125, 150K per month. Now, that isn't enough to bring down unemployment in any substantive way, but it is enough to keep the unemployment rate where it is, and it's enough to keep the expansion moving forward.
What's the positive in the economy right now? Is it manufacturing? Is that the best part of the economy that is showing up in the data?
Yeah, the strongest sector is manufacturing. That's where we're seeing the job growth. We've seen 4 or 5 months of consistent job growth, and a lot of the temp jobs that we're seeing are manufacturing related. A lot of jobs in distribution and transportation, and they're also manufacturing related. So that's the most encouraging aspect of the economy. And I think there's more room to grow. We've got a bit more in the inventory swing, and we're going to see a lot more vehicle sales and ultimately more construction activity, and that's going to lift manufacturing.
And yeah, on that note, when you're talking about vehicle sales, we just broadcast a conversation I had with the head of Novelis, who sells aluminum to those automakers in North America, and he was saying that when he looks around the world, the growth in the U.S. is the most tempered there. He's still not seeing the kind of robustness he'd like to see, and he thinks it's really sort of moderate. It's kind of flat because he's not seeing demand in construction. He's not seeing real demand in autos. Sure, they're doing better, but I mean, look where we are coming from.
I think that's a fair characterization. I mean, I think the economy is growing just at its potential rate. I mean, just enough to keep unemployment from rising, but not to bring it down. And
it sounds like you're describing like a C-level student here.
Yeah, which is actually, when you think about it, not bad compared to where we were. A year ago, it was a mess.
At least we're not failing anymore.
Now, it's not good enough, and we can't conclude that the coast is clear until we're growing above potential and seeing that unemployment rate come down. So we've made progress. We're headed in the right direction, but we've not quite there yet.
Mm-hmm. Well, what's your characterization then of where we are in this, given the jitteriness we saw in the marketplace last week because of the idea of yet another sovereign crisis overhanging us? I mean, was Hungary, whether or not it's a head fake, what does that do to your overall growth expectations?
Well, I think, if focusing on the European debt situation, if policymakers are able to calm financial markets soon, over the next couple weeks, a month or so, then I think the economic damage to our economy will be modest, that the expansion will remain intact and we'll make our way through this. Now, that's a big assumption, and policymakers probably will have to do more. The Europeans will probably have to step up and provide more support to their own economies.
That means buying debt?
Yeah, I think the ECB will have to buy more debt, may even have to end its sterilization of the debt to bring interest rates down and allow the euro to come down. And perhaps most importantly, I think they're going to have to engage in stress tests. The banking system will probably have to engage in stress tests, much like what we did a year ago, which provided clarity and brought our banking crisis to an end.
And we've been hearing that idea is being floated right now.
I think they're going through the stress test. We're helping in that process, but they need to make that information public.